What's up, guys? Welcome to another episode of the Business Project Podcast.
I love it.
We are finishing up this series with this episode. We're going to be talking about the different types of financing and funding that you can get for your business.
Yep, we're going to break down the different little places to go and all that good stuff.
So if you need some cash, if you need some moolah to help your business grow, we got you covered. We'll be back.
Yep.
The Business Project Podcast.
Business can be complicated.
We break it down so regular people like us
Can understand and find success. I'm John Crespo, accountant and consultant.
I'm Casey Bryant, marketer and event planner.
If you run a business
Or want to run a business,
welcome to the show. And we're back.
we're back.
This has been a good series.
A really good series.
I know for some people, when you talk about money and it's kind of like scary or maybe a little much.
Intimidating.
Boring.
Boring. Yes.
I don't know about boring though. Like this is, for me, is exciting.
Yeah.
It's money.
I think a lot of people get excited about money, and I think that there was so much really good information. So if you guys missed the last couple episodes, we went into, what did we talk about? So many things. We talked about
Business credit.
what the difference is between business credit and personal credit.
Personal credit. Yep.
We talked about how to build your business credit.
Preparation. Mm-hmm.
We gave the 5 P's.
Yep.
Right?
5 C's.
5 C's.
Yep.
6 C's because we added one.
We added one.
So if you guys missed those, go back to the past couple episodes and check it out.
Yeah, because we're not going to tell you what it is in this one. You got to go back. Mm-hmm. There's some
good
good
info.
nuggets, good gems, whatever you want to call it, but worth the listen for sure.
Yes. And then after this series, we are going to get into some really cool stuff. We have branding. We're going to talk all about branding, and not just in a sense of your logo and your colors, but the way that your business makes people feel. Yeah. And I mean, we have like 5 or 6 episodes just on branding. It is that important. It's going to be great, and you don't want to miss it. So that'll be the next series.
It's so true, because if you don't have it right, then you don't build your clients. You're not going to attract more clients. All that stuff goes into generating more money.
Mm-hmm. And I think even if you've been in business for a really long time, sometimes you have to, this is something that you have to look back on every couple of years and say, hey, how can we improve? Because styles change and things change. And so if you're not consciously making an effort to look back and see how you can continuously be improving in this area, then you're going to fall behind. So we're going to help you out.
That's right. Plan, do, check, adjust. Plan is like a never-ending cycle.
Never ending.
That's life of running a business.
Yes. Okay, so let's get into today, because I can't wait to hear of all the different places where we can get money for our business.
Yeah. Today's going to be good, because we're going to, not only are we going to talk about those places that you can get funding from, but we're actually going to give you some tips on how to prepare your packet that's necessary to be able to present to a lender to get the financing that you need.
Awesome.
Yeah, so some really good stuff.
Yeah. And so that when they go to the bank or go to a lender, then they're prepared and not just like, what do I need to do? You'll be all ready to go. Yep. Saving you some time.
Yes. So let's start with the most popular, right? Yeah. The most popular type of financing that a business can go for is SBA. Everybody's heard of SBA. Small Business Administration. Yep. When I'm speaking to clients, the first thing they ask for is, how can I get an SBA loan? Or I want an SBA loan. And, because everybody just knows about it. So the SBA is a government-backed loan. You don't go to the SBA directly to get the loan. It's done through a financial institution. A lot of people don't know that. Except for the past couple of years, because of COVID and things like that, the SBA did administer the PPP loan and the loan, PPP forgiveness loan, because those were able to be forgiven. And also it's called the EIDL, because those were part of the rescue package that was put together because of COVID. So the SBA administered that directly. So aside from that, if you want to go to the SBA and get a loan from the SBA, you got to do it through a bank or a online lender.
Interesting. Yeah. I did not know that. I already learned something new.
Yep.
Yeah. Okay.
This is great.
So are there only certain banks that do SBA loans, or do all of them do it?
Believe it or not, every bank can do it, but only certain banks do it.
Okay.
Right? Because there is a lot of paperwork. Whenever you're dealing with the government, there's a lot of bureaucracy involved. Right? A lot of banks don't want to deal with the bureaucracy, but the majority of banks do offer, and credit unions as well, do offer SBA loans.
Okay.
So I recommend, if you have a bank account at a particular location, ask them. Ask them if they offer SBA loans, and ask them what their criteria is.
So each bank will have a little bit different criteria?
Yeah.
Okay.
So it's kind of like if you're going for a mortgage, and you know how you ever heard of FHA and like USDA and things like that are government-backed mortgages? The government has its own set of requirements, but the bank that's actually writing the loan adds their set of requirements on top of it. Right? So every bank...
Because they have to make sure, even though the government backs it, the bank still loses if they don't get payment back?
Yep.
So they want to make sure that they're covered too.
Right, because the government only backs a percentage. It doesn't back the whole thing. So SBA, just to give you an idea of what it can entail, so the SBA will go anywhere from like $2,000 to $5 million, right? And the interest rates are typically, you look at prime plus 2. So you know what prime rate is?
I know what a prime number is. No.
Prime rate is the rate that let's just say the government sets, or the federal funds. I don't even know the actual term, like the proper term for it, but it's a set rate. The best rate you can get on anything is prime.
Okay.
Right? So prime rate is the best.
Like a prime rib.
Yeah. Like the best steak.
Okay.
If you get prime rate, if you get a loan that's just prime rate on it, you got the best rate. The SBA adds 2 points on top of that. So right now, our rate, the rate that's been set by the Federal Reserve, is around 7.2, something like that. Okay. Right? Or something in that. The prime rate actually is 7.25 or something like that. So a typical SBA loan would be 2 points above that. So you're looking at interest rates around 9%.
So it does have a little bit higher interest rate.
Yeah.
Because it's probably a lot of new businesses that do it, right?
Yeah. Yeah.
And there's a lot of risk when you start a business.
Believe it or not, you know what? Believe it or not, it's one of the better rate loans.
Oh, really?
For businesses out there.
Okay.
Because it's backed by the government.
Gotcha.
Because institutions have that kind of like insurance policy on the loan. So that's why the rates are the lower. Another thing to consider about SBA is the term on SBA, like the length of the loan, the amount of time to pay back is longer than if you get a loan from a bank that's not SBA.
Okay. So they give you more time to pay it back.
They give you more time.
Yeah.
Yep.
That's cool. Which is always good.
It is, right? Because then your monthly payment's lower.
Yeah.
So it helps you in budgeting and helps you, to keep the costs low, but you're able to plan out and budget better when you do it that way.
Okay.
Now, another thing to consider with SBA, though, is SBA typically wants 2 years of time in business. So you want 2 years of tax returns that you're going to need for an SBA. So it's not for the startup.
Right.
Yeah. So remember that.
But businesses that have been around for a while and they're like, okay, I'm ready to take it to the next level.
Mm-hmm. Yep. The SBA can help large businesses too. They'll do businesses that do $7 to $10 million in revenue. You can go get an SBA loan as well. But we start with SBA because it's the most popular.
Yeah. Is it hard to get an SBA loan besides the 2 years in business compared to the rest of the options?
No. Actually, SBA is the option that is more like a last resort kind of option. They really want you to try to get conventional financing before coming to the SBA. But when you go to the SBA, you do have to meet credit criteria. You are going to personally guarantee it. So this is one of those personally guaranteed loans. It's not like commercial credit, right? Because you're signing off. If the business can't pay it, they're going to come after you. And they typically want some type of collateral too as well. So it can be property, right? Or cash. And a lot of they will take your personal home as collateral on an SBA loan.
And we went into a lot of this in more detail in the past episodes in the series. So if you guys want more information in that, we got you covered.
Yep. So that's SBA. Yeah. If you want more information, like Casey said, go back and go to thebusinessproject.com.
Yes.
Get some good information there.
Lots of good info.
So the next one is like a traditional bank loan.
Okay.
That's where you go to the bank and you ask them for money. Now, what's good about traditional bank loans is that some banks, you don't need 2 years in business to be able to get a loan from them. They'll provide startup funding. It's not going to be a lot of money, but they'll make a decision based on your personal credit score. And if you have income coming in from like other avenues, other sources, they'll give you a credit card and they'll give you a line of credit or a small term loan to help start your business.
That's really cool.
Yeah.
Yeah. Would like a HELOC fall under that or no? Because that's more of a personal thing.
Yeah, HELOC is a personal thing.
Yeah. But you could use a HELOC for a business, but then is that considered commingling at that point?
Not necessarily.
Am I getting too technical?
No.
I'm getting too far ahead of myself?
No, that's the great, that's a question that a lot of business owners or entrepreneurs ask, right?
A HELOC is a home equity line of credit, by the way, if y'all don't know. Yep. That's actually what I've used to grow our businesses is if you owe so much on your house, but your house is worth so much, you can kind of pull out a draw in that. And you only pay interest on what you're borrowing. So even if you say you get $30,000 in a HELOC availability and you only borrow 15, you're only paying on the 15.
Exactly.
Yeah.
Exactly. And it's a cheap way to get access to money to help start a business as well, because you're paying on what you borrow and it's like a 30-year term payback. That's probably the cheapest way to get it, cheapest and quickest if you're starting out with no history at all in your business. But you have good equity in your home and you have a job. So you have a day job. You can get a home equity line and your credit's good. You get credit's got to be good too.
Yeah.
But yeah,
I didn't mean to jump the boat on that one, but
no, that is definitely a source. Right. And I should have had that on my list. It's definitely a source to start. When you're starting to get funding for your business, you fund it yourself with a savings account, right, or a retirement account, or you get a loan against your home, or you get a personal loan or something like that. So those are ways to fund it yourself. When you're using government or bank financing, that's when you got to worry about all the other stuff.
Right. Okay. And that's more of what we're talking about today is the bank, the business part of it.
Yeah.
Okay.
Back to the bank loans, if you have a good relationship with your bank or your credit union, some of them will offer you startup financing if your personal credit is good and you have personal income. They'll give you sometimes up to like $50,000 to help start a business. But you got to be in the prime. You got to be prime rib to get access to that kind of money. I mean, $25,000 or less is really not that difficult to get from a local institution. And you probably want to look at your more, what do you call them, regional or local banks, not the larger ones, to get that kind of access to funding in the beginning. Well, some of the larger ones will give you a credit card, though.
Yeah.
Yeah.
With a huge interest rate.
With a huge interest rate. Yeah. Be careful.
Yeah.
Be careful how you use credit cards. Mm-hmm. Yeah. They can help you and they can hurt you.
Yeah. So how hard is it to get approved for a traditional loan versus the SBA?
A traditional loan is a lot harder.
It is harder.
Yeah. So the bank doesn't have the insurance policy that the SBA gives.
Right.
So the credit requirement is going to be higher. They're going to want to see cash flow. The SBA will as well, but the bank's cash flow requirements, that means the money flowing into your bank, into your business, through your business bank accounts. They want to see a good portion with a good amount of cash coming in to cover your debt, right? They call it debt service. So your debt service has to be really healthy.
So what's the advantage of doing a traditional loan versus an SBA loan?
SBA has restrictions on what they'll lend to.
Okay.
Banks, you go doing traditional loans, banks can get creative on the types of financing that they will do for you. Banks will be more creative because a lot of them hold the loans on their books. So based on their risk appetite, you can have a bank they do some creative financing with them.
So there's a lot more flexibility.
Yeah. It's just the requirements are a lot harder. So higher credit score, definitely 2 years of tax returns. They want to see at least 3 months of bank statements. And we'll go over a checklist of like items to prepare when you're going to talk to your bank to make sure you have your ducks in a row.
Cool.
Yeah.
That'll be helpful.
For sure. So the next one is online loans.
Online. So we talked about SBA, we talked about traditional, and now we're talking about online loans.
Yeah.
So what is an online loan?
Recently, I would say that within the last 10 years, there's been a trend in what's called fintech companies. You ever hear of fintech? Financial technology, right? They break it down to fintech. These are online lenders. They're not banks, although there are some online banks, right? There are some, an example of online bank is like, you ever hear of a Chime?
I have.
Yeah.
Yeah. I was super bummed. We had an online bank called Simple.
Oh, yeah, Simple.
It was the best thing in the world. And they sold it. And then the company that bought it shut it down. And I can go into a whole rabbit hole about that. But it was great for users.
Yeah.
But that was an online bank. Yeah.
Yeah. Online banks and online lenders, those are created in a way to provide like easier access to funding. So a lot of them just look at your bank statements, and when making the decision, you don't necessarily need 2 years of bank returns or 2 years of tax returns.
Right.
You can just use like 3 to 6 months of bank statements. They really base their decision on cash flow and credit. So a lot of them are personally guaranteed loans as well.
Okay.
But your credit, they're more flexible on credit, so they will lend to lower credit tiers. So if you're like in the 600s, you have a good chance of getting a loan from an online bank as long as you have good cash flow.
Is the interest rate more? I could imagine it's probably a little bit more.
Yeah, interest rate's going to be higher. Depending on the lender, you have some online lenders that are associated with banks. So I'll give you an example, Marcus.
Okay.
Marcus is associated with Goldman Sachs, which is a large financial institution.
So it's like an affiliate of.
Yeah. So it's like their online arm. Because they're affiliated with Goldman Sachs, they have the flexibility to offer you better terms on a loan. So some pretty competitive compared to a local bank too. But these are quicker turnarounds too. So you can pretty much get approved and get your money in like 2 days.
Oh, wow.
Yeah.
That's nice.
That's how quick they run.
Fundbox is one that we used a lot for our business. You can borrow against your invoices. So they actually connect with your QuickBooks, and then they can see how much accounts receivable you have, and then you can borrow on those accounts receivable.
Yep.
The interest was insanely high.
It is.
But it is nice.
Yeah.
Because you can, as soon as you pay it back, the interest stops.
Yep.
It's very flexible.
Those are awesome when you need like quick access to capital. Let's say you got this project, this huge project coming. Like you need to purchase some equipment. You need to hire some people like ASAP. Those online lenders are perfect for that because the way they work, you can get that money. As long as you provide everything that they need, you get that money pretty quick.
Yeah. That's cool. And it is flexible and easy.
Yeah. Yep, it is. So that's online lenders. The next group, which is great, is called micro lenders. I'll give you an example.
Never heard of that one either.
Micro lenders are nonprofits. These are nonprofit lenders.
Okay.
And a lot of them get their funding from the government. From the government or local investors will fund these nonprofit lenders. And they deal a lot with, they have different categories of borrowers. So some of them are maybe geographically based. So depending on where you live, they'll lend to you. So local in Tennessee, we have a company called Pathway Lending, and they deal with just the state of Tennessee. So if you're in the state of Tennessee, you own a business, you can reach out to them, and they'll help startups all the way up to established businesses. And their criteria, they are more educationally based. So they'll make sure that your business plan is right. Like they kind of will guide you through the process because of the nonprofit status that they have. They have to be more educational around it. But they give you access to like up to like maybe about 250,000. Some do less. But I think I've seen some go up to like 250,000. Those are micro lenders. So look in your state, wherever you live, and do a search for micro lenders near me. You'll find the ones that are local to you, and then you'll see what they lend against. So it's definitely worth checking out.
Interesting. That's good. What's the positives and negatives of doing a micro loan?
Positives is you get government rates.
Okay.
Yeah.
So kind of like SBA.
Mm-hmm.
Okay.
You get kind of SBA style rates, and you also get the hand holding. So this is good for startups that are at least 6 months in business. You get the hand holding through the process. They're pretty good with that when it comes to the educational piece.
So they want to make sure that they get their money back.
Exactly. Exactly. Yep.
Okay. Cool. Microloans.
Microloans, yeah. So you're getting some good ideas. I hope you're taking notes. This is stuff when you're done listening to this podcast, you go online and do some research, right? And see what fits for you.
And this you might not be at an area in your business where you're ready for loans or any type of lending or funding, but this is great information to know for when you are ready. And again, we're all about getting you prepared for the time. So
exactly,
there's going to be a day possibly in your business when you're going to need this.
Most definitely.
You're going to remember it. You're going to be like, I remember that one time they did this podcast.
Yep. That's why we're doing this.
Yes.
So you can always circle back. All right. Next one is merchant cash advance. This is kind of like the fun box as well.
Okay.
Right? Because merchant cash advance gives you funding based on your cash flow. So they'll do an aggregate, like they'll do your average cash flow, monthly cash flow, and they'll lend you up to a percentage of what you bring in on a monthly basis. But these are high interest loans. So these are more, I like to call them alternative financing options. This is great for if you have that project coming up, that you need to get access to funding quickly, that you can pay back quickly, because this is more short-term funding. Very rarely do they go longer than a year in being able to use. Some of them are lines of credit that you can keep on accessing if you want to, but I've never seen a term or a lot of them that go longer than a year payback. So there's short-term financing options.
Yeah. So these are good, I feel like, if you do invoicing and you do the work before the invoicing, before you receive the money, and you get to a place in your business where you're like, I know that money's coming in, but I need to pay some bills right now, then you can use that.
Exactly.
Right? To help with your cash flow.
Exactly. It may work for your business, but it's not something you should go for if you need it to survive.
Yeah. Or to grow, really. Yeah. You don't get one of these types of loans and go buy a huge piece of machinery. Right.
Yeah, it's not meant for that.
No.
There's equipment financing for that.
Yeah.
So you want to, equipment financing is similar to an asset-based loan, where a lender will lend based on the assets that you own. So if you have property, you can get a loan against your property if you don't already have one, right? And if you have equipment, you can get a loan to purchase the equipment, and they'll fund the percentage of that equipment.
And then your equipment is typically what they hold as the asset against the loan, right? Yeah.
Yep.
So if you don't pay it, they can take the equipment back.
They can take the equipment back.
Like a car loan.
Yep. They'll do what's called on a business. So on the personal side, if you get a loan on your house, then the lien is on your house, right? You get a lien on your property. On the business side, they'll file what's called the UCC lien, because it's a business. So it's the same thing, but that's how they call it on the business side, a UCC lien. So they can do a search online and find out who's got a lien against what business. So there's if you get an asset-based loan, just know you mess up, it's going to be tough to get a loan somewhere else because your information's out there. You know
that TV show where they come and, I don't know what it's called, but there's a guy that comes after you and repos your car or whatever. They have people that do that for businesses. They go out and repo their equipment.
You know what?
That should be a TV show.
Some of these asset-based lenders are like sharks. They'll call you and they will threaten you.
Oh, wow.
They're like, we're watching your business. I've heard businesses tell me that they had these people calling them saying, we're watching your business. I see the equipment you have right there. We're going to come and take it when you're not around. They'll really threaten. Some of them, not all of them, but you be careful who you deal with. Let's just say that.
Yeah. But that's not going to be you guys, because you guys are going to have a solid foundation. You're going to build your business up right, and you're not going to have sharks coming after you.
Exactly. So, all right, now the last one that we'll touch on is called vendor financing. So you basically, if you're buying a lot of equipment from a particular vendor,
so if you have a Lowe's account, you get a Lowe's account to finance, and then you can pay it back.
Correct.
Yeah. Okay.
Yeah. Or the restaurant supply.
Right.
When you buy a lot of equipment for your restaurant, they'll finance it for you.
Okay.
And those rates can vary. Some of them offer good rates. Some of them offer good terms. It depends on the vendor.
Yeah. Is that kind of considered too, if they delay your invoicing? So say you have a 30-day or 60-day delayed payback, when you order something, is that considered financing to you feel like?
Kind of, sort of.
They don't add any fees on top of it, typically. So, but if you get a vendor account, then typically there's fees, right? Yeah. So it probably is different.
Yeah. It's different because this is more long term. So the vendor financing is more long term. If you have a 30 days to pay your invoice, that's just more accounts payable terms that they have. Some business do 30, 45, 60 days to pay back. That's good too.
Yeah.
That'll give you some flexibility to get your money out of that equipment that you're buying to pay them back.
Yeah, you can probably negotiate with some of these businesses too.
Oh, definitely.
Yeah.
Don't be afraid.
Yeah.
Look at that. You could tell we vibe. Yeah. You could tell. Definitely don't be afraid to negotiate.
Yeah, for sure.
Yeah.
On even these, can you negotiate in loans if you're working with a bank, or is it pretty much like this is what you can do?
Listen, don't be afraid to negotiate, right? Yeah. Some of them will say no, but what's the hardest thing what's the worst thing you do is just ask, right? Yeah. The worst thing they can say is no.
Yeah,
I would ask everybody, is this the best rate that you're giving me? Come on, we could do something better. Banks have flexibility, believe it or not.
Yeah, okay.
They have wiggle room. If they really want the business, they'll work with you.
Yeah, because they win on the loan too. I mean, you're paying the money every month.
Exactly.
They make interest, so. Yeah.
Exactly. Now, some asides that's not traditional financing or bank financing, you can have an investor, right? You can do investor financing. You can do crowdfunding as options. And I think we spoke about this probably in the first episode of the series.
Right.
Different types. But those are some ones that are just non-traditional. You get an investor, they want either equity or they want a term
like a lender.
Yep.
Yeah.
Or you can do a combination of equity and term, which is another pretty flexible or creative option. There's so many ways to go about getting financing for your company. Have you planned properly around what approach you want to take?
Yeah. And you have to have all these things that we talk about, you have to have in place when you go to an investor or when you go to a bank. They're not going to lend you money just off of your brilliant idea. Like, you might think that your idea is amazing, and it might be amazing, but you have to have the numbers and the plan to back it up. Otherwise, nobody's going to give you some money.
Exactly.
Yeah.
Exactly. So now what should a business get together?
To bring? I think we should put the checklist on the business project.
We should.
Yeah, because that's I see that. And we're trying to get shorter podcasts, y'all. We're already at 30 minutes.
So we're going to knock this out. And if you want to really see it, then, go to thebusinessproject.com.
Yeah.
So we'll just do like an overview of what to get together.
Let's do it.
Right. You ready?
I want to hear you talk really, really.
What do you think the first one is?
It is introduction. Oh, they're down there. Business plan.
Yes.
Yeah.
Get a business plan. So if you haven't watched the previous episodes, work on your business plan. If you don't have a business plan, I'm sorry. It's going to be tough to get a loan from anyone, even an investor.
Yeah. Business plan, so important.
Yep.
We did a whole thing on that. We did like 6 episodes on your business plan.
Exactly.
In our first series.
Yeah. And then the next one is financial statements. So get yourself a bookkeeping system if you don't have one. Mm-hmm. Get a bookkeeper or an accountant to help you create those. But you need financial statements.
We went into that too already. We'll link it in the notes of the podcast. How about that? That's a good idea.
Yep.
We'll do that for you.
Tax returns.
Blech.
We hit that already. 2 years. Get at least 2 years. If you have, 1 or 2 years of tax returns, depending on the amount of the loan. But get your tax returns.
Yeah.
Collateral. What's a collateral that you're going to provide? If you're trying to buy equipment or buy property, it's collateral around it. So
it's going to back it up. What can they take if you don't pay?
Yep, exactly. The legal documentation around your business. So your formation documents.
Contracts, partnership contracts.
Exactly.
Yeah.
So get all that stuff together, your state and federal legal documents. You're going to need all of that.
If you are in a partnership or have a corporation with investors or whatever, does every person have to sign for a loan? Every person that's an owner in your company has to approve of it?
Well, it's typically what they look for is 20% or more ownership in a business.
Okay.
That's to sign off on it. They call it beneficial owners.
Okay.
So if you have,
I couldn't imagine if somebody has a whole bunch of private investors that just have a small percentage going around every time and being like,
right,
we need your permission to do everything.
Yeah,
that'd
exactly.
be annoying.
Yep.
Okay, so 20%.
20% or more is the typical range. Some will go down to 10%, very few, but it's typically 20% or more.
Okay.
It's called beneficial owner. So So get that information. Make sure that they're on board.
Yeah.
We did the legal documentation, customer and supplier contracts. So if you're trying to get financing based on your receivables or contracts that you have with some clients, you want those contracts that shows the dollar amount that they're going to pay you for it, and the time that that's going to take to get that money, because you can get a loan against that.
Interesting.
Yeah. And then your resume.
Resume. I would have never thought to bring a resume to. Is this like a super sad story? Like, look at me and my beautiful kids. Please support us in our business. Is that what it is?
That's a
letter.
Yeah, a groveling letter.
Letter. Would that be good to bring too?
It would be.
Yeah.
Like, it's good to know your story.
Yeah.
Depending on the institution.
On the heartstrings a little bit.
Yeah, because a lot of institutions, believe it or not, some of the smaller ones have physical people looking at your application and really doing a personal decision if they're going to lend to you or not.
Yeah.
But for the resume is more what's your business knowledge of the loan that you're getting, like the industry, your industry resume.
Okay.
Especially for SBA. If you want to use SBA to purchase a business, they want to know what kind of knowledge you have in that industry that you're going to purchase the business on. So
that's smart.
A business resume is important. Yeah.
Yeah. Okay.
And that's it.
That's it.
Yeah. The rest you can find on thebusinessproject.com.
Yeah.
And
this was great.
Yeah.
Y'all, we're really trying. We're trying to keep our goal is under 30 minutes.
Yeah.
We didn't do bad.
No.
33 minutes.
Oh, that's good. And it is the last episode, so we had to, fit a lot in on this one.
Yes. Such good information.
Yeah. But I'm excited for the next series because this is where we get creative. This is Casey's wheelhouse.
It's going to be so fun, y'all. Some people don't like it. Some people like the financing stuff.
Well, we're appealing to everybody.
Yeah, we are. And you got to know all of it. You got to know the branding and the financing and the accounting and all the things. So
exactly.
I'm covering it all.
Yeah, so keep following along. Like, share, of course, and download on Spotify, Apple, all those podcasting, because this is such important information and we want to make sure it gets out to the masses.
Yeah. If you guys download an episode, if you go to Spotify, Apple Podcast, or any of the places where it'll let you download and you do that, it helps out so much. That's what they look at, I think, the most. So we much, much appreciate follow, share with your friends. All of that makes a huge difference.
That's right. Let's go.
Let's do it.
See you next time.
Bye, guys. Thank you.